Welcome, everyone. I'm Angelo Robles to Angelo Robles' Effective Family Office podcast, where I look to distill the best practices and best ideas of the world's most successful families and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of the family office. We're really excited about today's video podcast. It's titled Estate Planning Now and the Benefit of Low Interest Rates. It's incredibly timely, and we have amazing guests on today, which includes Brad Sprong, partner KPMG, JeffLesage, tax practice leader, KPMG, Kevin Ellman, CEO, Wealth Preservation Solutions, and Paul Miller, President, Wealth Preservation Solutions. We haven't done many of our videos and podcasts with four, and including me, I guess it makes it five participants, but they're all esteemed and it's all going to sync together. They all provide a specific value that covers the topic that we're talking about so well today. Many families of great wealth, of course, during COVID-19 are familiar with the market dislocations, especially in the private markets, coupled with historically low interest rates that our esteemed experts today will put together as to why now is an incredible time for complex estate planning and how many families could benefit tremendously. On that note, I would like to have a chance to introduce our first presenter today. That would be JeffLesage of KPMG.
Thank you very much, Angelo, and it's great to be here today. It's a great time to be talking about this issue, as you mentioned, with the low interest rate environment that we have, with the temporary high estate tax exemptions that we have that are going to expire in 2026. There couldn't be a better time to be thinking about this. In particular, when you take a look at the fact that we're in an election year and currently the House and the Senate are divided, but if the Senate were to flip and go to the Democrats in November, and Joe Biden was elected president, we'd have Democrats in the House, Senate, and in the White House. And I think we've all listened to the discussions around wealth taxes and tax the rich more, raise the corporate rate even a little bit. So I think taxes will be a big agenda item. That's why it's really, really important today to understand, looking at your estate plan. You may not have done it for quite a while now, but it's a perfect time to look at it. I know I'm 60 years old and I just revisited it again. There's a lot of things that have changed for me that I need to think through, particularly with that exemption potentially going away in 2026. So hopefully the low interest rate environment, which we'll touch on in a minute, along with the fact that there's a potential for, tax legislation down the road at some point in time, gives it a great opportunity to take a look at your overall estate plan, what you're trying to accomplish, and really look at it holistically in a very, very integrated way. So as I indicated, the real importance of today is to step back and look at a stress test for your wealth transfer plans. And why a stress test? Well, maybe your planning is 5 years or older even. And as I mentioned, I just revisited mine as well. Life changes, a lot of things going on with the family that may have changed. There's law changes that potentially could happen, and the interest rates are constantly changing. So a stress test is really, really important. It needs to be, as I said, all encompassing, looks at your wills, your trusts, your insurance, your asset titling, your overall business investment agreements. And it'll really highlight in your plan, your individual plan, the strengths, weaknesses, and the areas that you can really improve. And then you can step back and make a decision. Hey, I like what I have, I'm going to do nothing. Or I'm going to address the issues with the current team and maybe, look at using various firms or really one integrated firm. I think is the more important thing we're going to try to stress today, is to have one integrated firm that brings in all these areas around wills, trust, estates, planning, taxes, etc., to really help you develop that stress test and decide what you want to do for yourself personally. The low interest rate environment is really creating an opportunity for us. And why is that? Well, if you just step back and think about it for a moment, the low interest rates that we have means that the settler, whether you're using grantor retained annuity trusts, whether you're using defective grantor or type trusts, and whether or not you want to use a charitable lead trust or something along those lines. The low interest rate environment allows you to have less allocated to you as the settler and more to be able to transfer to your heirs through the estate planning techniques. And again, with the exemptions going down in 2026 from the current levels, it's a great opportunity to be looking at that right now. And Brad, I think you want to walk through some of the ideas around the GRATs and the other things, the defective trusts and the other items that we have, to explain about them in a little more detail.
Yeah, thanks, Jeff, and agree with you entirely. Now is a terrific time with the low interest rates and the temporary high exemption, which you mentioned will expire in 2026, if not sooner. So we'll walk through the three items. The first one on the slide here, the Grantor Retained Annuity Trust, or GRAT. That's a great opportunity for people to transfer appreciating assets to the next generation with no gift tax consequences. So in additionally, the GRATs have really little downside risk because they've been around for a long time and are very, very tried and true techniques. So a GRAT is created when a grantor contributes, hopefully appreciating assets, to a fixed term irrevocable trust. The grantor retains the right to receive the annuity, i.e. the annuity trust, and they get that annuity stream over the trust term, so the life of the trust. At the end of the term, any remaining assets that are left in this trust get distributed to the beneficiaries, which are generally the grantor's children. So this example is from January 2019. So step one, the grantor transfers $50 million to the GRAT, and it can be any amount. The $50 million is just our example. And in this example, we're using a term of 2 years for the GRAT. Similar, it can be a longer term, but normally we see a lot of short-term GRATs being used. Step two, as I mentioned on the outset, the grantor receives an annuity payment back from the grant to zero out the GRAT. And what I mean by zero out is the IRS assumes that the assets inside the trust are going to earn a rate of return. And in our example here, that they establish that rate of return every month. So you can see in our example here, the rate of return is 3.4%. So the IRS assumes that 50 million will make 3.4%. You have to calculate how much an annuity payment that requires out back to the grantor. So when the end of that trust term ends, there's zero left in that trust during that calculation. So what you can see by that is any appreciation then in excess of the 3.4% then passes gift tax free to your beneficiaries. The next slide shows us a comparison of January 2019 to June of 2020. And this is a demonstration of how the interest rates are so powerful. So as you can see, in January of 19, the interest rate the IRS assumed the assets would earn is 3.4%. In June, that was 0.6%. And what that does is that reduces the amount of the annuity payment out to the grantor, which leaves more in the trust to go to the beneficiaries. And you can see in our example here, the amount that went to the beneficiaries is 3.5 million versus the original amount of 1.2 million. They sell to an intentionally defective grantor trust, or an IDGIT, as many people refer to it as. This is also a tried and true asset freeze technique that has numerous advantages. So first, let's start with a quick discussion on what in the world an IDGIT is in the first place. It's hard for me to even pronounce sometimes, intentionally defective grantor trust. But what it is, it's an irrevocable trust, and it removes the assets from one's estate, but it still includes those assets in one's income tax liability. So it's effective for estate tax purposes in removing it from your estate, but it's defective from an income tax purposes. So the income earned in that trust, you will pay tax on in your own income, your own personal income tax return. So now let's move to the installment sale piece of the sale to the grantor trust. The purpose of the installment sale to the IDGIT is to freeze the value of the assets in your estate and to transfer the excess return from those assets to the trust beneficiaries. So it's a really good technique if you want to transfer assets and freeze the value of those assets in your estate, while also retaining a cash flow right in the future for you to use for your living expenses. So the strategy begins, as you can see, with an initial seed gift to the IDGIT, which is generally 10% of the property to be sold to the trust, or $5 million in our example. Next, the trust buys the $50 million of assets from the grantor for the $5 million of seed money, plus a $45 million promissory note with interest payable to the grantor at the applicable federal rate for the term of the promissory note. So in January of 2019, that was 2.89%. Now note that interest rate can be any really reasonable commercial term. So if you need a higher income stream, a lot of folks will raise that interest rate, but it has to be at least equal to the AFR in the month that you entered into the transaction. But remember, since this is a defective trust for income tax purposes, you do not pay tax on the gain of selling those assets because it's as though you sold it to yourself. And you don't pay tax on the interest income coming back to you from the note because it's as though you're paying yourself. And at the end of the 9-year term, in our example here, a balloon payment of $45 million is paid back to the grantor. Similar to the GRAT, the time is right to do this transaction. As the interest rate decreases, the annual interest payment also decreases, so more appreciation goes to your children. As you can see in this example, the interest rate in June of 2020 is 0.43% versus the 2.89% it was in January of 19. Thus, an additional $10 million goes to the beneficiaries today versus the 2019 transaction. So the last item we're going to discuss today in the low interest rate environment is the Charitable Elite Annuity Trust, or a CLAT. So a CLAT allows people to leverage their charitable contributions to shift wealth to family members in a very tax efficient manner. It's a split interest trust, which means the CLAT names 2 beneficiaries. The first beneficiary is a charitable entity. The second, the remainder beneficiary, is generally your children or grandchildren. And at the end of the trust term, the assets remaining in the CLAT are all distributed to the non-charitable remainder beneficiaries. So this one might be easier. Let's look at an example. So the grantor transfers assets into a trust, our $50 million again, and Nick's using the required interest rate of 3.4%, an annuity stream is calculated to zero out the trust, i.e. how much does the trust have to give each year to charity to have 0 assets left at the end of the trust term using a 3.4% growth rate. And in our example, that calculation was $6.5 million. So at the end of the trust term, 9 years, in this example, whatever assets are left go to your children. So you get to make some terrific gifts to charity during the 9-year period. And at the end of the trust term, $11 million in our example goes to your children free of gift or estate tax. And similar to the GRAT and the IDGIT, the low interest rate environment allows more assets to go to your children while still providing some terrific philanthropic support. So as you can see here, in January of 2019, roughly 58 million went to charity. In June of 2020, that number drops to 51 million, all because of the low interest rate environment. It's the exact same transaction other than that interest rate. And the difference being an additional $10 million goes to your children and beneficiaries. So a terrific technique. There's some really neat things going on in the market in this area. And one is people are combining several techniques together. So with that, let me turn it over to Jeff to introduce our next topic.
Thank you, Brad. And as Brad mentioned, the importance of combining several ideas he just went through and potentially others is really, really important in creating and preserving wealth. And so what we want to do now is give you some examples of things as to how you want to approach and look at that. And I want to introduce Kevin Ellman, who will walk you through that integrated approach that we've been talking about.
So we've been working with families for many, many years, and we've come to understand that the most effective way to achieve your goals and get the result that you want is to work with a team. We want to make sure that we approach all aspects of the plan, the business planning, the personal planning, charitable, investment approach, and make sure all of that works together in one coordinated fashion to achieve your ultimate goals. And most people don't do this. Most people will work with their accountant at one time, their lawyer at another time, perhaps their stockbroker, an insurance agent. So we think it's much more effective to have all those people working together as a team to try to make sure that they accomplish what you want to accomplish.
If I recall, you are a football fan, Miami's Dolphin fan, if I remember correctly.
Correct. My first 15 years with KPMG were in Miami.
So Do you remember who owned the Miami Dolphins in the 70s and 80s when they were winning the championships?
Very well, Joe Robbie.
And what stadium did they play in?
Joe Robbie Stadium.
Correct. So in 1990 and 1991, Joe Robbie and his wife passed away. And when they passed away within that 1 year, there was an immediate estate tax due of $47 million. The family, unfortunately, only had the bulk of their net worth was in the team and the stadium. So as a result, they had to sell the team. Do you remember who they sold the team to?
Very well, Wayne Huizenga.
Correct. Do you remember what the sale price was?
Around $186 million, I think.
Yeah. So after they made the sale, they paid the tax. I think it was 7 children split the remains. So not a bad take if you look at it that way. But do you know who bought the team in 2009 from Wayne Huizenga?
Wayne Huizenga sold it in 2009 to Stephen Ross, I think, for $1.2 billion.
Exactly. So the real question is, because the wealth transfer planning had not been done properly, did the family lose the $47 million of estate taxes, or did they lose the difference between what they sold the team to Wayne Huizenga for and the $1.2 billion they sold it to Stephen Ross? So that's why we're going to walk through today some planning techniques, and Kevin and I are going to take you through an integrated, comprehensive plan design, hopefully to help the families in the Family Office Association avoid this type of mistake.
So when we ultimately pass away, our assets are going to end up in one of 3 places, either with our family or a favorite charity or potentially with the IRS. And as Paul and I have done seminars around the country over the years, we've discovered that most people feel pretty strongly about this. Most people want the great bulk of their assets to go to their family, perhaps 80, 90, or 100%. Some families have important charities that they want to support, so they may divert, 10% to charity. But almost universally, most people want to give as little as possible to the IRS. Unfortunately, unless you do some significant advanced planning, this is probably not going to happen. Typically, the situation could look more like this, where maybe 60% of your assets end up with your family. You could potentially end up paying 40% of your assets, and this is similar to what happened to the Robbie family, to the IRS unintentionally. So unfortunately, unless you really plan ahead, it's possible that up to 40% of your assets could end up with the IRS. And this is what most people do not want. So Paul, could you take us through what the estate taxes look like today?
Yeah, so to Kevin's point, without the proper planning, a $100 million estate is going to have approximately a $30 million tax. You can see a $250 million estate is paying $90 million in estate taxes. And if you have an estate valued at approximately $500 million, you're paying almost $200 million in estate taxes. A lot different than, as Kevin talked about, that 100% family with nothing to the IRS. Within the current tax law, there are a couple of silver bullets that we have to accomplish the type of planning that we're going to outline today. The first is the annual exclusion gifts. Every individual can give $15,000, $30,000 per couple to whomever they would like. In most cases, they give this money to their children, the grandchildren. As an example, if they have 5 children and grandchildren, they could give $150,000 annually. And that type of gift is a use it or lose it. If you do not take advantage of that gift on an annual basis, it's not as if you can double up the following year. The second silver bullet you have is what Jeff previously talked about, the lifetime exemption. In 2020, the lifetime exemption is approximately $11.5 million, combined for a couple, $23 million, that can be transferred tax-free either during life or at death to your heirs. The top marginal estate tax rate above that is 40%. So back with what Jeff was emphasizing, why do the planning today? Under the current tax law, at the end of 2025, the exemptions revert back to the previous levels, $5 million per individual index for inflation, or 10 per couple. And as Jeff again stated, if we have a change in administrations, there's a very good chance that this could be accelerated and the lifetime exemption could be reduced to this amount quickly or even lowered, and a major potential for that top estate tax rate to increase from 40%.
So we have found it's helpful to think about the different levels of estate planning. So everybody on the planet that has any kind of assets or a family needs fundamental planning. This includes everything from basic wills and trusts. And that as we go up the pyramid, all these other levels, basic, intermediate, and advanced, involve some form of giving money away for estate tax purposes. So in basic planning, we're going to use our annual exclusion, as Paul mentioned. Intermediate planning, we're going to start thinking about giving away some of our lifetime exemption up to $11 million. And the advanced planning, these are the techniques that Brad and Jeff talked about, the GRAT, the IDGIT, and the CLAT. And then at the top of the pyramid, we're not going to talk about today, this is zero estate tax planning, which involves foundations and charitable giving at a significant level.
And Kevin, it's Angelo. What I noted in the presentation, which has been excellent so far, is this is really, I think we need to emphasize to the audience, historically low interest rates. And we saw the difference that makes in terms of the value added with money passing tax advantage via the trust to the heirs. It's significantly lower by a significant multiple based off the interest rates that we saw. And depending on a variety of situations, this is not going to last forever. It really creates an opportunity with market dislocations, especially in the private markets, where mark to market and other accounting or appraisal strategies for private securities, coupled with historically low rates, probably makes this a once in a lifetime opportunity at the interest rates and the other reasons that I noted that we're going through now. It's really an amazing time.
So Angelo, you're 100% correct. Now, even though it's an amazing time, imagine what happens if you sit down and say to somebody, you know, I think it's a good idea. Why don't you give away $100 million? So most people say, you know, they're not so sure about that. And I'm gonna ask Jeff. Jeff, what do you think the major reasons are that people hesitate to make significant gifts, you know, ultimately to their heirs, even if it makes sense, you know, from an interest rate point of view?
Well, I think obviously one of them, Kevin, is they can't get it back.
Right.
And so they think about that a little bit if they feel like somewhere down the road they don't have enough. So that maybe they want to get some of it back, but they can't. And certainly, you know, the loss of control around those assets and what's going to happen with the people where the money is given and how they're spent. If it's children, are they marrying somebody? And is there issues around some things that happen with the families down the road? So obviously the control aspect, the ability to maybe feel like you're not going to have enough money for the rest of your life. Those are the things that I think of anyway, and I thought of when I went through my own stress tests again with my children, just to make sure that you know, I'm comfortable in, you know, thinking through those issues and the decisions that I was making.
Well, I think, Jeff, you're exactly right. So again, as Paul and I go around the country doing seminars, we find that the reasons that you mentioned are the exact problems we run into. Most people feel, particularly if you're giving away a business asset, I don't want to lose control of this business. And no matter how wealthy people are always worried, you know, what if things go wrong? What if there's a major business reversal? Maybe I can't afford to do this. And then, as you mentioned again, what if I want that asset back? How do I get it back? So Paul and I have developed a strategy which is going to address each one of these issues and make sure that we can find a way to give away money while retaining control to make sure they can afford it, and believe it or not, having the ability to get it back if necessary. So I'm just going to give you a quick overview, and then we're going to take you through it step by step. So the first thing we're going to do is we're going to establish a special kind of trust to receive the assets. Then we're going to form what we call a gifting entity. This will be the vehicle we use to give money away. We're going to get a formal valuation, which Paul's going to take you through why that's so important. And then we're going to actually transfer the gifting entity. And then finally, because we're giving money away, we are going to implement insurance to replace those assets and also be available to pay taxes. So this looks complicated, but it's fairly straightforward, actually. We're going to create something called a spousal lifetime access trust. And it's exactly what it sounds like. So I'll use the example of the husband first. The husband is going to take, say, $50 million, and transfer it to this spousal lifetime access trust. And he won't be able to get to the money, but his wife will be one of the beneficiaries and she will be able to get to the money. Now, the wife is also going to do the same exact thing. So she's going to take $50 million and transfer it to this trust. She won't have access, but the husband will. So they've both given away money for estate tax purposes, but they retain the ability to get to it if they need it through their spouse. And then when they ultimately both pass away, the money's going to pass to a children's trust. And as Jeff mentioned, this is going to provide liability protection in case they're sued. And most importantly, it's going to provide protection in case they ultimately get divorced. Those assets are going to always stay with the family. And we're protecting it for them so they can use the money if they want to. We're not protecting it from them. We're just going to protect it from outside attack. And then ultimately, it's going to go to the grandchildren and then eventually the great-grandchildren. So we call this gifting entity, it's called a family limited liability company or a family LLC. And think of this as your own private, like mutual fund. So you can take investments, real estate, perhaps shares of your family business, and you're going to transfer them to this limited liability company. And it's going to be used as the gifting vehicle. And it's also going to get some important discounts, which Paul's going to talk about, which will really help it be more effective as an estate planning tool. So here's a picture about how it works. So both the husband and the wife are going to transfer assets to the family LLC. So they no longer have those assets, but they're going to retain membership interest as the managing member. And that's where they get control. They make all the decisions. They're completely in control of the assets, no matter what. And then they may be giving away shares eventually into the future. And that's going to be perhaps their children who are going to be what we call a limited member. So they have a financial interest, but they don't have control. So at the end of the day, for our example, both husband and wife are going to put $50 million into the family LLC. We're going to have this new entity with $100 million in it.
So step 3 is we're going to engage a valuation company to perform a valuation on a non-controlling minority interest. And the IRS allows that a interest in a business that does not have control and cannot exercise control, you can get a discount. And the typical discount is approximately 30%. So in this case, we're going to have a $100 million entity that's going to be valued at $70 million, and it has a great impact on the wealth transfer plan. So step 4 is the transfer of this family entity into the 2 trusts that have been established. So first, each person, husband and wife, are going to gift their lifetime exemption to these trusts. And back to what Brad spoke about at the beginning, this is the seed money for the trust. So they now have seed money where they can now do a transaction between themselves and the grantors. The remaining balance of the family business is owned by the husband and wife, has a value of $47 million after the gift. They will sell that to the trust, and as in Brad's example, take back a note. In this case, the combined value of the note will be $2.8 million, and we're going to amortize that note. So at the end of 20 years, that note will have been fully paid off. And basically, that $100 million asset will now be owned in the 2 trusts, totally out of the estate. So basically what we've been able to do was transfer that entire $100 million plus all of the associated growth out of the estate for estate tax purposes. Step 5 is maybe the most critical. This addresses 2 very important areas. As Kevin spoke about, by the way we established the 2 trusts, both the husband and wife have total access to those assets if they need them. But if one of the spouses dies prematurely, we are going to lose access to one of those trusts and $50 million. So as a result, we are going to implement $50 million worth of insurance in each trust, funded by the cash flow generated by the family LLC. As a result, if either the husband or the wife die prematurely, there'll be $50 million of life insurance paid into the trust that the surviving spouse is still a beneficiary of, and that individual will still have access to the entire $100 million. And if you recall in the Joe Robbie family situation, they had to sell a team due to the lack of liquidity. At the second death, we will have created $100 million worth of liquidity through the life insurance, thus hopefully being able to pay any estate taxes and avoiding having to sell any family assets due to an estate tax. This is the impact of doing the planning. A $100 million estate has a $31 million tax. If no planning is done based on a 5% compounded rate of return, that tax grows to $62 million in 10 years. In 20 years, grows to $103 million. With no planning, you can see the family out of the 100 million will receive 69 million. 10 years later, while that 100 has grown to 171 after taxes, they're still only receiving 108. And in a 20-year period, you can see well over $100 million is going to taxes.
So this looks pretty complicated, but it's a pretty good overview of this whole transaction. So in the center, we have the Spousal Lifetime Access Trust, which owns the LLC interests, and it has the $50 million of life insurance. The LLC has been gifted and sold to the SLAT. So the grantor, in this case, the husband, is going to receive payments on the portion that was sold, and the spouse can have income as needed for any living expenses that they may have. And ultimately, at the end of the day, the SLAT, with the LLC interest and the $50 million worth of life insurance, is going to go to the heirs in trust, protected forever.
So this slide really shows the impact of this planning. And I think it's really important. The couple was 65, so let's go out 20 years, which is within 2 or 3 years of their life expectancy. If we had done no planning, the taxes on that $100 million in their estate would have grown to $103 million. As a result of the transfer planning that we've taken with this 5-step approach, we've reduced the projected taxes to $33 million. What's the impact that has on the family? You can see as a result of this planning, we have transferred an additional $80 to $100 million to the heirs. And all we did was basically take the money from the left pocket to the right pocket by utilizing the strategies that are available under the tax code. And the impact is at its highest right now, as we discussed, based on the fact that we have low interest rates and we have a higher lifetime exemption, both which will not be there down the road.
So we have a saying in the business, don't try this alone at home. This is, as Brad said, tried and true estate planning techniques, but it's not simple. And it does require the coordination of several professionals. So this is an example for you of how a team works, and we're big advocates of working together as a team to make sure you accomplish what you want to accomplish. So to summarize, assets have been transferred in an extremely tax-effective manner while providing asset protection to the family for generations to come. As Jeff mentioned earlier, the number one concern for most people is that access and control has been maintained. And in this example, $63 million of estate taxes have been saved, projected into the year 20. And then $100 million of projected increase in assets will go to the family instead of potentially the IRS. So our commitment to you from KPMG and Wealth Preservation Solutions is to provide you with the stress test complimentary. So as Jeff mentioned, this is going to review all the different elements of your wealth transfer plan, wills, trusts, insurance, business agreements, investments, to make sure that everything is happening the way you want it to happen. And you're going to find out if you had to use your plan today, would it actually work and how would it actually work? And at the end of that, you're going to find out there's some strengths and some weaknesses in your plan, maybe some things you need to address today. And then as Jeff mentioned, it's entirely up to you. You may decide, I think my plan is okay. I don't really need to do anything else. You could say, I'm going to take the report and go back to my existing team, and that's perfectly okay. Or you may want to consider working with our team, with KPMG and Wealth Preservation Solutions, to address all the issues and make sure that we optimize your wealth transfer plan. So thank you for attending today. Let me turn it back to Angelo.
Thank you so much, Kevin. This was really a fantastic presentation today and incredibly timely. I'd like to take a moment to thank Brad Sprong and Jeff Lesage of KPMG and Kevin Ellman and Paul Miller of Wealth Preservation Solutions. Yeah, I mean, it's always great to talk about investing and opportunity and venture capital and growing companies. And we do that so much because it is incredibly timely to our families. But it's really important to look at, I mean, those are crystal ball issues. No one knows with what the Fed is pumping into the markets, with what's going on in certain industries, the direction of where investments are going to head. Even the smartest investors often stumble. But the opportunity to have something more concrete, like mitigating taxes, like transferring your wealth with estate planning, with opportunities that present itself right now, are concrete opportunities to get real value and effectively have less money go to the IRS and more money go to your heirs. So it could be used in a purpose that's going to be important to your family values and their specific needs at the moment. It's important to really understand, and I know we mentioned this a couple of times during the presentation, but I don't think that I could emphasize it enough. The market dislocations, especially in the private markets where some industries have been hit very, very hard, creates an opportunity in estate planning coupled with historically low interest rates. And when I say historically, it's as low as it's probably ever going to be. And that may change, who knows? I don't know, a month, 2 months, 6 months, a year. So the opportunity presents itself right now. What I mean by that is even if you had an estate plan that was done a week before COVID hit, so recently, just a couple of months ago, it needs to be revisited right now for the dislocation and the incredibly low interest rates. This is not something where you set it and forget it, where you leave it aside and look at it in 3 or 5 years. In perhaps normal markets, that may be a little bit true. That is for sure not true during the situation and the challenging situation, unfortunately, that we're going through right now with COVID-19. So I hope you found today's presentation, which is really mitigating taxes and estate planning, specifically during COVID-19, of value. Everyone, I'm Angelo Robles. I'm the host of Angelo Robles's Effective Family Office podcast on Apple, iHeart, Stitcher, Spotify, and other platforms, and the founder and CEO of Family Office Association, a global membership organization dedicated to the interest of successful families and their family offices. We do a significant amount, now more than ever, of proprietary content. And I would have said host global programming, but during COVID, of course, that's not happening. But we are hosting multiple times per week live digital opportunities for our members to participate and to hear really incredible content like today at the moment. One of my members said it best: you went from doing 12 events a year to doing well over 150. And he meant that a little bit tongue in cheek, but it was incredibly accurate. That is true. So this is an incredible time to be active with a community of thought leaders, of experts, your peers, and hopefully as a membership organization dedicated to that community. That's what we do, and that's what we provide now more than ever during the times that we're going through. Our website is Family Office Association. My direct email is angelo@familyofficeassociation.com. You can also find us very easily on social media. Much of our videos make it up on our YouTube channel, so please go there and subscribe. It's free. It's incredibly easy, and a great name for what I do. It simply is Family Office. So go to Family Office on YouTube and subscribe. On that note, again, would like to thank Brad, Jeff, Kevin, and Paul. Great job today. Look forward to the next time. Thank you, everyone, for participating.
Thank you.
Thank you.
Thank you.
Thank you.